Good afternoon and welcome to the Loungers PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Nick Collins and CFO Gregor Grant. Good afternoon to you.
Good afternoon, everyone. Thank you very much for joining the Loungers results presentation for our year ending April 2023. I'm going to start with some highlights, then I'll hand over to Gregor, who's going to go through the financial performance, and he'll then hand back to me and I'll talk through the strategic and operational review. But just to start with the highlights, I think it'd be fair to say we're delighted with our performance over the year. We've achieved record revenue of 283.5 million, industry-leading like-for-likes of 7.4%, and we've opened what is for us a record number of sites, opening 29 new sites. Importantly, margin pressures have been largely mitigated, and we are experiencing inflationary pressures diminishing, and Gregor will cover that in more depth. Our new site openings continue to perform very well, and we expect to open 34 sites in the current financial year. And we now believe that the potential scale of the lounge business in the UK is at least 600 sites. And we've carried out a detailed network planning exercise with our property team to get to that number. We've launched Brightside during the year, our new roadside dining brand, with 2 sites open in Exeter and Saltash. And we really believe our value for money focus means that we're well positioned if there is a consumer downturn. But importantly, we're really pleased with the start to FY24. In the last 12 weeks, we've seen no change in consumer behaviour and current trading remains very strong. Over to you, Gregor.
Thank you, Nick, and good afternoon, everybody. I'd like to take you through the numbers, if I may. It's a reasonably well-trodden path, this. We'll have some highlights. I'll then take you through to look at our like-for-like sales performance and bring you up to date there. We'll touch a little more in terms of margin, our current thoughts on inflationary pressures, and then I'd like to wrap up with cash flow, a little bit of a deeper look at CapEx, in particular in the lounge estate, and then finally looking at net debt and updating you on our banking amendments, which we completed in June. First slide, slide 4. What I'm doing here is reporting on the FY23 financial performance. I'm putting that into context against our results in FY19. And the reason for FY19 is twofold. Firstly, that was the last full year pre-COVID. So it's a clean comparative, and I think helps to make more sensible comparisons in terms of margin and so forth. But equally, it was the year running up to our IPO in April 2019. So it finished just a couple of weeks pre the IPO. And I think in that respect, what it shows is a really strong progress that the business has made over its 4 years as a public company, with revenue up 85%. And when you look at that, what's driven it is the fact that we've added 76 sites to our estate. So we've gone up from 146 to 222 over those 4 years. But that's been accompanied by a really strong 4-year like-for-like sales performance of just under 23%. As we look down the chart on the left-hand side, so revenue at 283.5 million, plus 85% on a 4-year basis. Gross profit 113.2, showing growth of just over 78%. And what you see there over the 4-year period is some margin erosion of 160 basis points. And that's something we'll come back to in more detail in a few slides' time. In terms of adjusted EBITDA on the old IAS 17 metric, very much how we measure performance internally within the business. So that's post a traditional full rent charge. EBITDA of 34.2 million. That's up 66% over the 4 years, and you'll see you've got 140 basis points of margin erosion there. So less margin erosion on the IAS 17 basis, testimony to our continuing strong property discipline within the business. And then the bottom row on the chart, profit before tax for the year of £7.3 million, and that's after a net impairment charge in the year of 1.6 million. So an impairment charge of 3.4 offset by a release of prior year impairments of 1.8. Moving on to slide 5, and this is where it gets a little bit complicated, I'm afraid. What I'm looking to do here is to compare our performance in FY23 against our performance in FY22. And the FY22 year was impacted both positively and negatively in some quite significant ways. So, for example, in FY22, the first 4 weeks of that year, the business could only trade externally after the end of the third lockdown. And then in Christmas 21, the business was impacted by the Omicron variant and the damage that did to Christmas trading. More significantly, though, on the plus side, the business really benefited in FY22 from the government's support measures in terms of the reduced VAT rate, which was worth 15.1 million, and from the reduction in business rates. So what I look to do in this chart is at the top half when we're looking at revenue, so that 283.5 million on a headline basis up 19.5%. When I take out the 8 weeks of trading in both years, which were impacted in FY22, and I take out the VAT benefit, underlying revenue of 237.5 million is still up 19% year on year. In terms of adjusted EBITDA under IFRS 16, so we're down to 47.3 million this year from 53.6, and with a headline margin erosion of 590 basis points. But when you take out those 8 weeks of impacted trading in the prior year, which clearly negatively impacted FY22, and you take out the VAT benefit, which was a really big benefit in FY22, and you strike EBITDA ahead of business rates, where we had benefit in FY22, you'll see that our underlying IFRS 16 EBITDA is up from 38.7 million to 44.4 million. So an increase of 15% there. And the margin erosion is reduced to just 70 basis points. And within that 70 basis points, you'll see labour cost as 40 basis points and higher energy costs for 30 basis points. Moving on to slide 6, and like-for-like sales performance. There's nothing new being reported here in the top two thirds of the chart, as a very strong 3-year like-for-like of plus 17.6%, and it's important to remember that one when you're looking at 1-year like-for-likes at the moment. That's 17.6% testimony to a really strong performance from the business throughout the entire COVID period and immediate post-COVID recovery period. On a 1-year basis, our like-for-likes are plus 7.4%. And then more recently, over the 12 weeks to the 9th of July up to last Sunday, we reported like-for-likes of plus 5.7%. That was modestly impacted in the first week by the timing of the Easter school holidays. And school holidays are very important for trading in lounge. If you exclude that first week, over the 11 weeks to the 9th of July, the business was plus 6.5% on a like-for-like basis. On slide 7, what I look to do is to show how that plus 7.4 1-year like-for-like splits out across the different age cohorts within the estate. It's a slightly bumpier pattern than I've maybe shown in previous years, but the most important point remains very much the same. If you look at the 55 sites that we opened pre-April 2015, so the three columns to the left-hand side of the chart, you'll see they're displaying like-for-like sales, which are as strong as any other cohort in the business. And I think that's really testament to the fact that we continue to evolve in the lounge business. And secondly, it's testament to the very high standards of maintenance in those older sites. It's not a like-for-like sales performance which is driven by the rollout program and by the opening of new sites. Moving on to margin. On slide 8, what I look to do is just to show the bridge between our FY19 margin on an IAS 17 basis of 13.5% and the margin of 12.1% reported in FY23. And that 140 basis points of damage is effectively done on the cost of sales line. And that's cost of sales, meaning cost of goods sold for food and drink purchases, and also site labour. And you'll see that we're ahead 120 basis points in terms of cost of goods sold, food and drink purchases. And I think that's something which we'll see continuing in the years ahead. And we're 260 basis points to the negative in respect of labour. And I think when you look at that, that's a function, firstly, of a very tight labour market coming out of COVID. It's a function of the cost of living pressures over the last 12 to 18 months. And that in part reflected by 2 years of very strong national living wage increases. Further down the P&L, you'll see a standout there in terms of energy costs, negative 50 basis points over the 4 years. The business continues to be very well protected through its May 2020 hedge. But if you think at the end of FY23, that was by then only covering effectively 75% of the estate. So the 25% of the estate which we've opened post-May 20, all their energy costs were effectively hedged through to the end of September 24, at market rates at the time of their opening. Then the final point here, 100 basis points of benefit in terms of site rent rates and service charge. So continuing, as I say, to display very strong property discipline. And over that 4-year period, you'll see our rent to revenue ratio has improved from 5.2% to 4.6%. Slide 9, in terms of our thoughts on margin outlook. I think our view at the moment is we're definitely seeing inflation moderating. Those expectations in the chart there for July FY24, they've certainly come down some way from the last time we reported at the back end of 2022 in terms of inflationary expectations. What I've got in the chart there is an expectation of food inflation over the year of 6%, drink inflation at 3 to 4%, labour inflation at 8%, and then the impact of those higher utility costs in respect of our newer sites leading to 20% inflation on utilities over the year. Bear in mind that utilities last year were 2.8% of revenue, so a much lower percentage of our total sales than either cost of goods sold, food and drink, or labour. And in terms of moderating and offsetting that, we probably expect that we'll need to take selling price of 5 or 6% over the course of the year. And effectively, we took 4% of that in our April menu launches in Lounge and Cosy Club. Looking in a little more detail at food inflation, which has clearly got a lot of press coverage over the last few months with reports of inflation levels of 19 or 20%. In our business, when we look at the top 20 ingredients, which cover approximately 45% of our food purchases, we saw inflation of just over 13% year on year, April 22 to April 23. And within that, cooking oil and eggs accounted for nearly half of that inflation. When we look at those same top 20 products over the last quarter one of our FY24 financial year, we've actually seen marginal deflation, wholly driven really by reductions in the oil price. If we look at drink inflation, that has been more modest over April 22 to April 23 at 6.8%. And then looking forwards in terms of national living wage, our expectation for next year is that we'll probably see an increase in the 7% plus range. So we're expecting to see that reducing from the 9 or 10% rates which we've seen over the last 2 years, and coming back to the sort of levels where pre-COVID the business could manage those increases in terms of maintaining its margin. Over the medium term, the goal within the business is very much to restore its margins to those pre-COVID levels of 13.5%. I think the biggest area of opportunity will remain in terms of food and drink margins. We've recently renegotiated a major element of our food supply, as well as our drink contracts, and we're looking to enjoy the benefit of that from the second quarter onwards. And there remain further opportunities to consolidate our buying within the supply chain, most notably in respect of fresh food supplies, be they produce, meat, dairy. In terms of site labour, I mean, that'll continue, I think, to exert pressure on margins through national living wage increases. But as I said a couple of minutes ago, we expect that to revert to levels of annual increase which were more like those seen pre-COVID and which were manageable within the business. Labour control remains an area of very significant focus within the business. We're currently reviewing all of our flex labour budgets across all of our sites within the estate to ensure that we're maintaining that level of control. In terms of site variable costs, there's no silver bullet here, but there are a large number of individual projects underway, be they covering laundry, cellar gas, print, refuse collection as a few examples. And all of these offer us opportunity, which cumulatively will be very worthwhile. In terms of fixed costs, I expect us to continue to benefit from that tenant-friendly property market, where we've seen through our property discipline a continuing decline in our rent-to-revenue ratio. Equally, we had a new rateable value list come in on the 1st of April, and that sees us benefit immediately in the current FY24 year. But in the years ahead, I expect us to see some favourable challenges to some of those new rateable values as well. And as the estate continues to grow, so we continue to have the benefit of our leverage of our central cost base across a wider estate. I think the only really significant headwind which sits out in front of us over the next few years will be in respect of energy costs as we come out of our May 20 hedge in September 24. My expectation is at the moment is that there's probably another 100 to 150 basis points of potential margin impact as a result of energy costs, albeit that is before any positive impact of the efforts we're making within the business to reduce our consumption. Moving on to cash flow and CapEx. On slide 11, we've got a cash flow statement there. That's under IAS 17, so it's old style in that adjusted EBITDA is after a full rent charge and rent cash outflow. So adjusted EBITDA of 34.2 million converts into cash generated from operations of 36.1 million, benefiting from a cash inflow from working capital of 5.6 million in the year. And that's a sort of annual inflow from working capital that I'd expect to see on the basis of a continuing positive like-for-like sales performance and the continuation of our new site rollout program. From that 36.1 million of cash generated from operations, I deduct 7.9 million pounds of maintenance capex, and I include in the definition of maintenance capex there basically all capex which is not specifically new site capex related. So, for example, that 7.9 million pounds includes 2.7 million pounds on getting pretty close to completing the lounge kitchen reset program. Also got interest paid in the year of 1.1 million, and you come down to free cash flow in the year of 26.9 million, which comes very close to completely funding the new site capex in the year of 27.9. We then have 1.2 million in terms of freehold acquisition, and then 2.7 million pounds on the restaurants acquisition, which was effectively to fund the acquisition of two further freeholds. Cash outflow in the year of 4.9 million. In terms of capital expenditure, bottom of this chart shows the 37 million pounds of capex spend, which we see in the cash flow on the previous slide. Over the course of the year, our capex creditor increased by 2.2 million. So you've got a net total capex spend in the year of 39.2 million. 29.6 of that was in respect of new sites, and within that 29.6 million, we spent 26.9 on 29 new sites that were built and opened in the period. Those 29 new sites being 24 lounges, 4 cosy clubs, and our first Brightside. The maintenance capex in the year of 3.9 million represents 1.3% of revenue, and on top of that, we had a P&L maintenance spend of 1.6% of revenue. Very consistent with previous years in terms of a total repair and maintenance capex spend of 3% of revenue. And as I mentioned earlier, the other major element of capex in the year was a 2.7 million pounds, which we spent on 61 kitchen resets in the lounge business. That's a project which was commenced pre-COVID. It was halted during COVID and now has been completed, with the project finally finishing in early May of this year. On slide 13, what I do is just compare the lounge new site rollout, comparing it in FY23 to FY19. And you'll see the first point there, we opened 24 new lounges in FY23. We opened 23 new lounges in FY19. So whilst the rollout program has accelerated and we'll look to accelerate it further in FY24, it's important to remember that we've been opening 25 plus new sites for a number of years now. Second row on the chart looks at the average landlord incentives that we've received. So back in FY19, on those 23 lounges, we received an average of 13 months of incentive from our landlords. And those 13 months were a combination of landlord contribution and rent-free periods. Those 13 months, when you roll forward to FY23, have increased to 24 months, with the major increase being seen on the capital contribution line. What's really important, though, is those capital contributions haven't been bought by offering our landlords longer lease terms or higher rents. You'll see the average lease length in FY23 was 15 years, so actually modestly down on FY19. Whilst average rents have increased slightly from 62 to 67, I think that's very much a function, firstly, of us taking on slightly larger sites, and secondly, absolutely getting prime pitch with our new site openings in FY23. And most importantly, the rent to revenue ratio forecast for year one of those new site openings at 4.9% is consistent with the rent to revenue ratio of our FY19 sites. And what we'd expect to see over the next 2 or 3 years as the revenue in those FY23 sites increases and the rent remains the same, that rent to revenue ratio will reduce. So, for example, if those sites increase their revenue by 10% over the next 2 or 3 years, then that rent to revenue ratio would decline to 4.4, 4.5% or so. In terms of average capex per site, net of landlord contributions, that's up from 649 to 835. Important though, we opened one exceptionally large lounge in the year, Martello Lounge in Clacton-upon-Sea. If we exclude that, the average spend was 785k. So still a significant increase over that 4-year period, and three major factors driving that. Firstly, as I say, the larger average size. So typically you've got a 12% increase in covers, but also greater external areas. Secondly, enhanced design and build. And that's both in terms of design and look and feel of the sites, which I think most people would say has never been better. But secondly, in terms of some of the equipment which is going into sites on day one, and some of the build techniques which are being used to reduce future maintenance charges. And then the third bucket, not surprisingly, relates to the elements of inflation which we've seen in new site openings. So labour costs have clearly increased. We've seen inflation in some of the kitchen equipment, and we do our best to mitigate that by buying in bulk and beating increases. And thirdly, probably elements such as the steel, which is involved in extract and so forth. Final points to make there. Those FY23 openings in their first year to date, average weekly sales of just under £31,000 per week. That compares to just under 23k per week in their first year of opening for the FY19 cohorts. And when you look at how that FY19 cohort has grown post-opening in FY19, you'll see our FY23 openings are still some 13% ahead of the FY19 cohort. And most importantly, that 30% plus crocky is being maintained in our new site opening programme. Final slide from me is just an update in terms of our non-property net debt. So we finished the year with underlying net debt of 6.1 million. That's 3.4 million higher than our underlying net debt at the end of FY22. And worth bearing in mind that that is after £37 million of cash outflow in respect of CapEx, and also £2.7 million to fund the REIT acquisition of those two freeholds. We refinanced our bank facilities in June of this year. We reduced our term loan to 20 million from 32.5 million by prepaying 12.5 million of it. And at the same time, we increased our RCF by 12.5 million to 22.5 million. So we've got no change in our total liquidity, but clearly a more efficient structure in terms of mitigating higher interest rates. There's been no change to the covenants. The margin is 1.75% on that borrowing, and the facility runs for 3 years to June 2026. So we finished FY23 with a very strong balance sheet and funding position, ready to go into FY24. And with that, I'll hand back to Nick, if I may.
Thank you, Gregor. So first slide from me, slide 16, just like to look at our sales performance and highlight the degree to which it's outperformed the sector. I think we're fairly unique in looking at over the last 10 years, as that chart shows, our positive like-for-likes, and then we've accelerated that growth post-COVID. And whilst accelerating the rollout, we've consistently achieved like-for-like sales growth, and I think that reflects both the innovation and evolution within the business. And looking at that 17.6% that Gregor mentioned earlier, FY23 sales being 17.6% higher than FY20. If you take the 142 sites that were open in FY20, they were achieving average sales of £25,900, and they're now achieving sales of £30,500. So it really, I think, demonstrates the growth. And I think that's far stronger than the vast majority of our competitors, and it reflects both volume growth as well as price. We're often asked about, in the last 3 days over the roadshow, asked a lot of questions about what we're seeing from the UK consumer. How's our customer behaving? It's really clear we've seen no change whatsoever in their behaviour or sentiment. Based on our experience, the UK consumer remains very positive. And that's, we look at the data a lot. So look at sales patterns, days of the week, category sales, regionality, no shift whatsoever. A couple of things that we have seen. Brunch daytime sales continue to dominate growth, but evening growth has been really encouraging. And that's something that's improved over the last 12 months. And then some of the changes that we saw immediately post-COVID are starting to slow down a bit. So increased cocktail sales, increased pudding sales, they're not as extensive as they were immediately after COVID. So as I said, looking at the next slide, slide 17, it's evolution alongside value for money that continues to drive our sales growth. And if we think about menu innovation, immediately post-COVID, we were a little bit more timid in terms of the way we developed our food, just because we wanted to protect our kitchens and protect the teams working in our kitchens when labour was harder to find, it's harder to recruit people. And what we're saying here is that our menu innovation is no longer being constrained by labour concerns. And some examples of that, in lounge, we've seen flatbread sales overtake sandwich sales at around £16,000 per week, which is a really significant change. Also, the importance of Asian dishes. We introduced nasi goreng back in April, and that alongside bang bang chicken means Asian dishes now represent 15% of our mains in lounge. And then just thinking about Cozy Club, we introduced a sea bass dish quite recently, and that alongside the salmon and the fish cake dishes that we serve means that fish dishes now represent 18% of our mains in Cozy Club. And what these points, I think what they really help highlight is the fact that because in all of our brands, we're not wedded to any particular specific cuisine, it gives us real flexibility to deliver what the customer wants. And then we've said significant changes coming in the draft lineup across Lounge and Cozy Club. So in a few months' time, we're refreshing our draft range, and we're going to introduce Hofmeister, Cruz Campo, Menabrea, and Henry Westons. And they'll be replacing Amstel, Estrella Damm, Punk IPA, and Stowford Press. And the second bullet there, this is driven by a desire to stand apart from high street brands. I think this is, again, it's really important. When we introduced Estrella Damm, probably 12 years ago, we were just about the only people stocking it in the UK. And it's now really commonplace across bars in the UK. And we want to be different. We want to introduce new people to new brands. And I think Hofmeister, Menabrea in particular are really exciting additions to our bar. And of course, because we're a bigger business and because we have that benefit of scale, we're going to see a cash margin benefit from the new deals as a result of our estate growth. But as I said, value for money, really important. And we represent excellent value for money in both Lounge and Cozy Club. And our competitiveness has improved. We've taken more price than we have historically, but our competitors have taken even more price than we have. And just looking at those prices there, a burger and fries in Lounge, £10.95 and £14.50 in Cozy Club. They represent really keen prices. We think that are very competitive. Next slide talks about the continued investment and innovation in operational support. And it's a really important theme within the business in this financial year. It's all about making life easier for our site teams. At the end of the day, we just want them to deliver great food and drinks and amazing hospitality. And these are some of the steps that we're taking to allow them to do that. So we've introduced regional community managers in the lounges. So we have 6 regions. There's 1 in each region. And they're there to encourage sharing best practice and to drive community involvement. It's really important. The lounges are a community-based business. We talk about having to earn our place on each of the high streets where we trade across the UK. And these community managers, they're there. You can't be prescriptive. They're there to nudge, share best practice. We've also introduced a head of brand on the Cozy Club side, for marketing on the Cozy Club side. I think there's an opportunity there for us to drive awareness through social media and online presence. And I think importantly, improving our content alongside using our customer database better. We've also introduced a new online booking facility in Lounge. This is only really used at Christmas. Typically, you can't book tables in the Lounge, but whereas previously they were having to write it down using pen and paper, this new booking system makes it easier for our teams. And then the fourth point, we've introduced regional recruitment and talent managers. Again, 6 across the regions. People is everything in our business, and we're giving our operations team more support, more resource here to help them find and keep the best people. As Gregor noted earlier, our medium-term goal is to restore EBITDA margins to pre-COVID levels. And there's an ongoing focus in the business on improving conversion. And we talk a lot about our regional operating structure and the fact that we have low site to ops ratios, and that ratio of around about 4.5 sites to every one of our operators. And one of the real benefits of that is that it allows us to deliver improved financial performance. And that's typically seen in 2 areas. First one in driving improvement in gross margin consistency, and secondly, in reducing the costs associated with staff turnover. By us having our operators having fewer sites to look after means they can be in their business more often, talking to their teams more often. Labour is a constant challenge in our business, but I think importantly, it remains one of our best attributes. It's a real strength of ours. We're targeting cost savings from smaller lines, and we've got specific projects, Gregor touched on them earlier, around cooking oil, cellar gas, print and laundry. None of these are really going to move the dial, but there's lots that we can go for. And equally, there are longer term initiatives taking place in the business focused on energy consumption and waste to landfill. I think energy in particular, it's a really sizable opportunity. It's something that we haven't focused on before. It's not going to happen overnight, but there's a lot for us to go for there. We get to slide 20, and it absolutely remains the case that our people and culture drive our continued success. And we're really proud we've supported our team through the cost of living crisis through increasing their pay. And for our HODs, that's our general managers, assistant managers, head chefs and sous chefs, we've provided 11% salary increases, and we funded that through buying out half of their bonus potential alongside giving an average 6% uplift. And we did that after lots of consultation in the business. And we also continue to support through some of the benefits you have in working in our trade. So free food and drink when you're working alongside our staff discount. We continue to invest in learning and development, and a statistic that we're really proud of, 67% of our operations team have been promoted internally from site roles. So that's a statistic we're very proud of, and there's lots that we're doing in terms of training for new joiners, for our supervisors and for our managers, and indeed leadership training for more senior people within the business. We continue to work hard to be an even better employer. We launched the commitments in FY22, and those remain at the heart of everything that we do, talking a lot about fairness, about paying competitively, and about work-life balance and mental health. All right, we have an annual staff engagement survey to make sure we understand how our team feel about working at lounges, and it's a really honest way that we can understand how we're doing. We did one a few months ago, and the scores are better, but it's really clear that there's still more that we can do. And then we have Lounge Fest. We close the business down for a day. We have a big party, our annual staff party in a field in the Cotswolds. It remains the biggest and most important investment on the cultural side of the business. It's an amazing day, and it's really, really key in terms of our staff retention. We've also strengthened the leadership team further during the year. As you can see on slide 21. 3 people here that we'll talk about. Guy's joined us as our Chief People Officer back in November. First time we've ever had someone that senior, just entirely focused on our teams. And he's challenging all aspects of recruitment, learning, development, HR. I think really importantly, making sure that I just spoke about engagement, driving better engagement and providing our operators, our senior operators, with more strategic advice. Kate Lister joined us in October as Marketing Director. First time we've ever had a marketing director, and she's really pushing and challenging the exec to invest time and cash in marketing. And it's interesting, on the Cozy Club and the Bright side of the business, they're both brands, traditional brands. And then Kate's also in charge of the lounge community team. Then finally, Jono became our commercial director in January. Great example of an internal promotion. He was previously lounge head of food, and he heads up purchasing, risk, compliance, maintenance. But I think the really important part of his role is all about improving processes and efficiency as the business grows. So next few slides go on and talk a bit about property and the rollout and the pipeline. We're continuing to open new sites that are performing really, really well, as Gregor demonstrated the numbers, increasing the average level of EBITDA. And we have real growing confidence about the types of locations where lounge can work. Our bread and butter is opening in secondary suburban high streets, small market towns, and those continue to dominate our rollout. But we're also seeing really strong performance in mixed-use leisure and retail schemes. And I'll come on to talk about an example of that in a minute. The pipeline's in a great place. We've got 34 sites planned for this current year, 31 lounges, 1 Cozy Club and 2 Bright Sides. And we now see scope for at least 600 lounges across the UK. We've talked a lot historically about how we thought the number that we were using of 400 was very conservative. And we're now happy to kind of look at that in a little bit more detail and update. And we believe at least 600. And the way we've come about that figure, our uniquely experienced in-house property team have produced an in-depth model based on our detailed knowledge of the UK. And we've worked on this for over 12 months. And it's literally a case of 5 people going across the UK and challenging each location, saying yes, maybe or no. And we haven't included the maybes in there. So we believe it's a conservative number. And if you think about that 600 and you put that alongside some of our competitors and reference how that compares, I think that really helps demonstrate that it's still a conservative target. Cozy Club remains an integral part of the business and is fundamental to our growth plans. Cozy, it represents 22% of our sales, and it's one of the leading bar restaurant operations in the UK. We often get asked about Cozy Club from investors. I think it's less understood. It operates in a more competitive marketplace, but it's a business that we're very proud of. And there's still scope to almost double the size of the estate. And it performs just as well as Lounge, I think, importantly, from a return on capital perspective. As I said, we now believe there's potential scale for Cozy Clubs to get between 50 and 65 sites. And that's in the city centres and the large market towns where it really performs best. We open Oxford in September, and that's a great site that we're really excited about. And we'll continue to put new Cozy Club opportunities into the pipeline. But I think it's natural that as the ratio of Cozy Club to Lounge openings is going to reduce as the number of opportunities reduces within Cozy Club. I want to look at a few case studies now. I'll go through them quite quickly, and obviously ask questions at the end if you have any. First, this slide just looks at Bristol, and we still believe there's an opportunity to double the size of the estate in Bristol. And when we think back to that number of 600, I think this is a great example of highlighting that scale opportunity. We currently have 5 lounges and 1 Cozy Club trading in Bristol. During the year, we relocated one site, Porto Lounge. I'll talk about that in the next slide. We also opened a new lounge, Branco Lounge, in the Abbeywood Retail Park, and I'll go through that in a little bit more detail. 3 other lounges all trade really strongly. Cozy Bristol, right in the centre there, just around the corner from our office, is one of the best EBITDA sites in the business. Yet even here in Bristol, which is our heartland, we've been here for 22, 23 years, we still believe there's opportunity for us to open 5 new sites in those locations listed there. I think helps us demonstrate there's still lots to go for. So I mentioned Porto Lounge and its relocation, and this slide just looks at that in a little bit more detail. Porto's in fish ponds, and in relocating it, one of our oldest sites, Porto, it's allowed us to more than double sales and EBITDA. And you can see on the left there, the old Porto is a tiny site, had 45 covers. It's astonishing that it achieved those sales of just over £18,000. But not representative of the type or size of sites that we open now. So we were relocated to, as you can see on the right, this was previously 2 shops under the same landlord. One was a card shop and the other was a pharmacy. We've joined them together, paying a higher rent at £57,500, but you can see their gross average weekly sales of over 43,000 and a fantastic forecast return on capital of 43%. Looking at the next slide, the other Bristol site that I mentioned that we'd opened during the year was Branco Lounge, which is a great example of how well lounges work in the right retail schemes. And we believe these types of locations have an undeserved poor reputation that's come about over recent years. And we certainly find that the right scheme gives us a really good opportunity to open a site that will generate high levels of sales, high levels of EBITDA. Branco Lounge here was previously the unit was previously a Frankie and Benny's. And if you look at that chart there, the plan there that you can see on the slide, you can see the retail that's around it. What you can't see is on the left is there's a big Ministry of Defence office with lots of workers, and there's loads of residential surrounding it. So this scheme generates really high footfall from local shoppers, local office workers, people who are going there for the gym, and that's just the kind of environment where we want to trade. Rent of 75,000, just above average. A great average weekly sales of 42,000. Net capex was good, and a forecast return on capital of 38%. The next study looks at the Cadno Lounge in Neath, again, one that we opened this year. And we've included this one because, again, I think it helps highlight the scale opportunity. There are a lot of towns in the UK that are not dissimilar to Neath. Similar size in terms of population, similar demographics. And if you look at the competitive landscape in that chart there on the right-hand side, this is just the kind of competitive landscape where Lounge typically trades. So from a food and drink perspective, there's a Costa, there's a Greggs, there's a JD Wetherspoon, Subway, a Pizza Hut. And from a retail point of view, there's an Argos, Marks and Spencer's, Boots, a couple of banks, etc. This is our kind of territory. The scheme here was a new build scheme that was built by the local authority. We trade alongside a pool, a library, great for our community credentials, and a really competitive rent here, £37,500, and a decent landlord package of 32 months. They wanted us in this scheme because they knew what we'd bring to that local community. And indeed, the business has traded really well. Average weekly sales of 40,000, great return on capital of 33%, and not too far away from other lounges. Zinco Lounge in Swansea, 6 miles away, and Croeso Lounge in Mumbles on the coast is 12 miles away. And last one, I promise, in terms of case studies, but Cosy Club Canterbury. Again, we opened there in August, and are delighted with the way it's performed. It's in a lovely heritage building. It was previously a Closs and Hamblin department store, and we're trading over 4 floors here. And if you look on the right-hand side, this helps kind of demonstrate, I think, the different environment that Cosy Club trades within. So lots of brand names that I'm sure you'll be familiar here with from a food and drink perspective. Wagamama's, Coke, Bill's, Tortilla, Francomanca, Las Iguanas. Lots of operators in Canterbury. It's a great, great city. And we trade really well here. Average weekly sales of 48,600. And you can see, so the Cosy Club's higher sales, higher levels of EBITDA, higher CapEx, but again, great returns on capital. And an oddity, we bought the freehold here at 850,000. We did that. It was just a really good opportunity. We'll do a sale and lease back on that. Our model isn't owning freeholds. And so last slide before I sum up, talks about Brightside, our new roadside dining brand. We opened the first one in Exeter in February. We opened the second one in Saltash in June, and we're due to open the third one in Honiton in a few weeks' time. It's early days, but we are relatively pleased with the sale performance. What does that mean? I think when we opened Exeter, it was a little bit quieter than we expected. And we received quite a lot of negative feedback in the very early days. And one of the things we've learned, Root Restaurants was the previous occupier of this site. And when we bought the 3 sites, we bought them from a trading business called Root Restaurants. And they were an American diner, much lower price point and a very different offer. And I think when we first opened, and some of the former Root customers came and visited us and were disappointed that we weren't like Root, and the Brightside model is quite different. It's a higher price point, all freshly cooked food, etc. And that was quite dispiriting for our team. But what we've seen subsequently, after an initial flurry of negativity, the feedback's been really strong. The sales are building in Exeter, and we're pleased with how we're doing there. And then we've opened in Saltash, and Saltash has opened really strongly. Really great sales that we've seen there over the last 6 or 7 weeks. And we're excited about opening in Honiton in a few weeks' time. And we expect to learn a lot more over the next 6 weeks. So this business is more seasonal than either the lounges or the Cosy Clubs. And we're expecting around a 40% uplift in sales over the coming weeks. And I think we'll learn a lot more about the business then and how we deliver at that really busy time. Some key observations so far. Local customer base is really important, just as important as the passing motorist. I think that's particularly the case for Exeter, and that site's quite hard to find, particularly if you're going southbound on the A38. More legacy loyalty than we expected, and that's the point I just mentioned about the disappointed Root customers who were looking for their more value-led US diner style operation. Speed of service is so important. I mean, we're good in Lounge and Cosy Club. We're quick, but we need to be quicker in Brightside. Recruitment hasn't been too challenging. We were worried about it, and it hasn't been quite as hard as we expected. And it's the first time we've sold pizzas, and so that's been a great experiment. Got pizza ovens in each of the Brightside kitchens. And one of the things we've learned is they're not as taking up as much in the sales mix at lunchtime as we might have expected, but they are still very popular in the evening. And then our final point, everyone loves an avocado bathroom suite. The look and feel and the design of the Brightsides is amazing. And I really thoroughly recommend you to go and visit. One of the most talked about points is the avocado sinks and loos that have received quite a lot of attention on social media. So that's Brightside. So just some final thoughts, really, and just summarising kind of factors and themes that we've already talked about during the presentation. We have once again delivered a sector-leading performance. And I think, we've shown over the last 10 years that despite accelerating that rollout, constantly opening sites through our evolution, innovation, focus on value for money, we're delivering consistent like-for-like sales growth. Our new sites are performing very well. Rollout's accelerated to 34 sites, but it's not really an acceleration. We opened 29 last year. It's a level that we're very comfortable with. I think really importantly, our rollout is self-funded from consistently strong cash generation. This is through internally generated cash flow that we open these sites. And we now believe there's a potential for at least 600 lounges in the UK. We've got a best-in-class senior team. We continue to invest in our people at all levels across the business. And inflationary pressures are diminishing. And I think there's a really clear medium-term goal to return margins to pre-COVID levels. So that's it from me. We are obviously very happy to answer any questions.
Nick, Gregor, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Nick, Gregor, as you can see, we have received a number of questions throughout today's presentation. And if I may hand back to you and kindly ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
I think I'll take the first one, Nick.
Okay.
This is from Mark Gordon James. Reasonably multifaceted question. I think the first element is addressing free cash flow. Hopefully you find that element of the presentation useful. It's something we have been talking about specifically in presentations really since coming out of COVID, and once we restarted a full new site opening program. Last year, FY23, free cash flow of 26.9 million was pretty much wholly funding that 27.9 million pounds of new site opening capex. Next year, with the 34 new sites that we're expecting to open, we'll be fully self-funding. Then we'd typically expect to be generating some excess cash from FY25 onwards, subject, of course, to any decisions we make about further acceleration of the rollout, given that we've got 600 plus lounges to go for. Dividends, I mean, they are a topic which is very much up for discussion amongst the board. It's something we think about and review regularly. Clearly, the focus within the business has been on its rollout program and the acceleration of that. And I think it's fair to say that when we discuss topics of dividends or share buybacks, for example, with investors, the overwhelming enthusiasm is that we focus on our rollout, we reinvest our cash in that rollout, and in generating that 30% plus property return. I think the final element then relates to EPS. And the impacts on our EPS, in particular of IFRS 16. I mean, it's fair to say that in some respects, the business may look expensive on a PE ratio basis. I mean, that's clearly not untypical for growth companies like ourselves. IFRS 16 doesn't help us in that in the early years of a lease, you tend to see your profits depressed due to the higher interest charge, which is allocated to that lease in the early years. At the moment, we're probably generating something like £2 million lower pre-tax profit under IFRS 16 than we would under the old accounting standard IAS 17. Clearly, over the life of the lease, that reverses, and so in the coming years, we'd expect to see, as I say, that underperformance under IFRS 16 switch around and reverse. I mean, other element, there's a reference, I think, to the Shore Capital report, which was interesting because it made many of the points that as a business we were making at the time of our IPO in terms of encouraging investors to look at us not necessarily on that EPS measure and to understand what was in the EPS measure. Because other elements in addition to IFRS 16 would be a relatively high depreciation charge relative to many of our competitors. Depreciation typically about 4.7% of revenue, and again driven by the number of new sites we've got and the fact that they suffer a higher depreciation in the early years as we depreciate elements of fixtures and fittings, technology and the like. And probably the final element in terms of EPS to just draw on is the fact that our share-based payment charge, again, which is reasonably substantial. We have broad-ranging share plans across the entire business. Over 1,000 employees are benefiting from that. But again, there's an element of double whammy in your EPS when you think you're using a profit after tax number which reflects a share-based payment charge, and then you're using a fully diluted number of shares as well, which clearly incorporates in it the shares which will be issued under those schemes. Hopefully that addresses all the elements of that question, Mark.
Thank you, Gregor. Next question says, do you think there is an overhang in the shares? Where might it be coming from? I mean, Lion Capital are who invested in the business 2016 when we were a private business. I still own 25% of the shares, and they are they're a very supportive holder and investor. And Robert, who's a representative of Lion Capital, sits on the board. So hopefully that answers that question. The next question: would you be looking to grow inorganically at all? Do you feel you might be a good takeover target, especially at this share price? Inorganically, I think it's unlikely. One of the great things about this business is that we're investing the cash that the company generates and achieving fantastic returns on capital. And I think it would be really hard to achieve similar returns on capital through acquisition. Might we be a good takeover target, especially at this share price? It's very difficult for me to comment on that. I mean, I think we've made our kind of views clear on our kind of how we feel about the share price, and clearly we're doing everything we can in terms with the investor community to try and demonstrate why we believe it should be valued higher. Next question asks who we're taking market share from, and what does. Well, I'll answer that bit first. So it's really hard to answer that question. I mean, clearly suppliers coming out of the market, I think that's calmed down a bit there now. I don't think there are many kind of large scale restaurant pub operator closures still to come. We must be taking share from someone. I think one of the great things about Lounge and Cozy Club, for that matter, is we service so many day parts, so many occasions, so many broad demographics that we nick a little bit of trade off everyone. But clearly, when we open in Neath and we're achieving sales of over £40,000 a week, there must be other businesses in Neath which had been receiving that money. But I think it's quite spread out. The next part of that question asks, what does the roadmap look like for site rollouts? Any preference for locations, and are you finding good deals on new sites? So, I mean, when we think about rollouts, we see huge opportunity across the UK, as hopefully we've talked about. One thing that's really important is that we don't have too much bias towards specific areas or regions in a short period of time. Otherwise, it puts too much pressure on our operators. And that leads to a kind of a dilution of culture and higher risk of us not delivering well when we open a site. So yes, we are nudging further into the northwest, into the northeast, but then equally we're opening lots of sites in central England, Wales, and in the south. In terms of preference for locations, we're equally kind of whether that be secondary suburban, or it might be small towns, or it might be coastal locations, or indeed retail schemes. We're kind of happy with all of those. And in terms of good deals, as Gregor hopefully demonstrated, rent levels have been very consistently excellent. I think what's great is that what hopefully we're showing is that we're finding better sites in terms of their pitch, in terms of their prominence, and that's helping us generate higher levels of sales. Next question asks, we've had wonderful growth in new sites and like-for-likes. What specific steps have management discussed to try and get the share price to be more reflective of your success? Is it getting on the dividend list, increased retail investor focus, etc.? I think Gregor's talked about dividends, and we're at the moment we had both sets of brokers and indeed our financial PR advisors talk to the board just last month about what we need to do to allow the to get the share price to be more reflective of our success. And I think it'd be fair to say, increased retail investor focus is indeed something that we've discussed. And hopefully shortly you'll see that we'll be paying for some analyst research to be made available to retail investors, which will hopefully help in that regard. Would you be able to give us a feel for the per site economics of Brightside so far? No, I think it'd be fair to say. I think one of the things that we talked about when we first were introduced Brightside was that we saw the metrics being somewhere in between a lounge and a cozy club, and I think broadly speaking that's still our intention, but I wouldn't really want to go into any more detail than that. Next question: will the new headcount additions to operational, community, and recruitment detailed in the slides add materially to central cost, or still sensible to think as 7% of revenue? Gregor, I might.
Well, I don't think I'd use the word materially. Clearly, we continue to invest in the business to fund our to meet our growth targets, and that's something we've always been really good at as a business in terms of investing, 12, 18 months ahead, so that we can support that 34 new site openings growth, for example. 7% of revenue has typically been where we are in central costs, and that's very much where we'd expect to be in the coming year.
Next question asks, given the growth, how are you finding recruitment and staff retention? We're finding it's fine. It's not easy, but recruitment in our industry has never been easy. It's certainly nowhere near as difficult as it was 18, 24 months ago. And if you think about it in the context of us opening 29 sites last year, we created 900 and something jobs, and we filled those jobs. So we're comfortable with where we are. We have the benefit of being a bigger business and fantastic opportunities for people who want a career in hospitality, and that's something that we shout a lot about and are very proud of. Next one says, please can you give a view as to what your major competitors have done and how the competitive environment has developed over the last year? First thing I'd point is we don't have, particularly in lounge, a major competitor when we compete, as I said earlier, with coffee shops, sandwich shops, pubs, restaurants, and a bit of everything. In terms of how the competitive environment's developed over the last year, I think the first point I'd make is everyone's taken a lot of price. And going back to the point I made earlier at the start of my section, we think we're in a competitively better place because, yes, we've taken price, but we haven't taken anywhere near as much as everyone else. And so we think that, from a value for money perspective, that puts us in a good position. I think more broadly, supplies come out of the market. Everyone's had to up their game a bit. And I think for the consumer, that's a really good thing. And I think it's important to note that we're not the only people doing well out there. I think if you look at our listed peers, there's lots of older, quite mature, very, very big businesses there. But if you look on the private ownership side, there's some fantastic businesses doing really, really well. And so I think it's important that the kind of the sector's not all kind of covered in doom and gloom. And indeed, it's a really good environment for small startups and entrepreneurs who want to give it a go, because there's lots of property available, and landlords are having to realize that they need to be more flexible in terms of their approach. Do we feel that Brightside margins will be similar to those at cozy clubs and lounges in due course? I think that's a great question, and one that we don't know the answer to. We're really hoping that in November, December, when we're doing our interims, we'll be in a better position to talk about Brightside in terms of financial metrics. The way we think of it is it's in the lab. We'll have 5 Brightsides in 12, 18 months' time. And we haven't got any more in the pipeline. And what we need to understand is but ultimately, will they generate a return on capital that's similar to or better than lounge and cozy club? And if that's the case, is it a good use of our cash? We don't know the answer to that question. We think there's a big revenue opportunity. We're pretty confident about that. From a conversion point of view, we know the margins will be good, but labour's an unknown, and that's something that we're going to continue to work on. Next question: what was the most pressing and important learning from the staff survey, and what are you doing to tackle it? Great question. I think the one that probably most frustrates me is I think we're really good as a business at listening and being in the business. I visit between 5 or 10 sites every week, and if I go on a site, I'll ask everyone a question. And generally, if you ask our team lots of open questions, they're pretty quick to tell us what we're doing wrong, and that clearly gives us the opportunity to resolve it. I think what surprised me, upset me, and was probably the most important learning from the staff survey was that there's still pockets where we've got people who are really unhappy about the way that they're being managed and the way that their experience as an employee of lounges. And we don't always get it right. And the best thing about engagement surveys is they tell you exactly where those locations are, and that gives us the opportunity to go and address it. And so, when we hear that, we'll immediately focus a lot of attention there and figure out what we're doing wrong, or most importantly, who is doing something wrong, because we're a people business, and if we have the wrong people in leadership positions, then that affects our customers. What's the geographical spread of the estate now? Are there areas of the country you feel are underexposed to the brands? For reference, I'm in the southeast, Kent, Sussex. Well, I mean, the business started in Bristol and has gradually spread from there. So we have we have 20 sites in Wales. We're very strong in Devon and Cornwall, and we're very strong in the Midlands. But as you probably rightly point out, we're less strong in the southeast. So while there is lots of opportunity for us up in the northwest and the northeast, and we are spending a lot of time there, equally we're in Kent a lot, we're in East Anglia a lot, because there are loads more sites for us to open in those locations. Next question. I've previously asked about the risk of competition from other operators opening similar outlets, and you explained the factors that you believe give lounges a unique competitive advantage. Have you looked at Titanic Brewery's bod concept, I think that says, which looks to me like a lounge, but with a competitive edge gained by offering an attractive range of traditional car scales? I'm not actually familiar with that one. I'd love to know where it is. So we can. I'm guessing it must be in the northwest somewhere, but I don't know. But listen, we're pretty good. I mean, one of the best things about being in London, doing our results roadshow for 3 days, is that we get to try everything in London, which is a really good use of our time. I mean, there are other people who do an all-day offer, and we try to stay quite close to it. No one of scale has copied what we do, and quite a few have tried. There's businesses like Megan's, for those of you who live in London. It's some of what they do is not dissimilar to a lounge. It's probably aimed at a more affluent demographic than what we do. And it's interesting, I'd love it if we could sell traditional car scale, because I personally am a big fan, but there's no way that we can sell traditional car scale, because BSLs form relatively low proportion of our sales. And if car scale would be a small subsection of that, and there's no way we'd get through the volume to get through proper casks without the quality being damaged. I think in terms of the risk of competition, it's always there, but you have to be able to look at yourself and say, we're the best out there. And there are always things that we can do better. Food, drink, coffee is an area of real focus now. So there's no what's the word, kind of complacency. I think we're always looking and challenging what we can do better. Did I miss your time frame, re 600 outlets? Is that question? No, because we haven't put a time frame on it. At the moment we're opening. We expect to open around 30 lounges a year, and we're at 195 at the moment. So just doing the maths, that's a lot more than 10 years. There's lots to us to go for. Clearly, a decision that we might have to take at some stage in the future is that we might accelerate that, but we're very happy at the current rate as things stand.
Nick, Gregor, that's great. And thank you for being so generous with your time and for addressing all the questions that came in from investors today. And of course, the company will review all questions submitted today and we will publish those responses on the Investor Meet Company platform. But perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Nick, could I please ask you for a few closing comments?
Yeah, I think, as I just say, we're delighted with our performance during the year ending April 23, and it's consistent with the performance that we've delivered for the last 10 years. We believe there's enormous scale for Lounge in particular across the UK for at least 600 sites. And from a performance perspective, our margin pressures have largely been mitigated and the inflationary pressure is diminishing. Our customers are behaving just as they always have. There's no change in consumer behavior, and we're really positive and optimistic as we look ahead. Thank you very much.
Thank you.
Nick, Gregor, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Lounges PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.